trade defense for your futures, Mikey. You know about trade defense for options and everything else. But aside from just closing the trade, I want to talk to you about how you can defend against a position that is going against you in futures. And what better example than the short-term interest rate product, small 2-year yield, that's in the midst of one of its greatest outlier moves ever. Maybe you can give a little context for the last 6 months in action here in this 2-year. What does it mean for it to go from $1 up to above $20 here? And how big of an extreme are we at in terms of, you said you poured through the last year of data in this market. We're at, like you said, a top 3 or 4 all-time move even today in short-term rates. So maybe a little context for a move like this that you and I are both short into.
Yeah, absolutely. I mean, basically post financial crisis 2008, the Fed cut rates to 0. Essentially, you can see it along this x-axis here. We're sitting just above 0. I think these rates were around, 20 basis points or something like that. So for the longest time, the plan was to keep rates low and help stimulate economic growth. And then we started having a little bit of maybe inflation fears, maybe some COVID fears, a lot of things kind of sprinkled into the mix, and 2-year interest rates started bopping a little bit higher. And the Fed ended up coming out and saying they do expect to raise interest rates. That's their mechanism of slowing economic growth or bringing in some of the inflation. And then we just saw a move in 2-year rates that basically outs Bitcoin and all the other more volatile asset classes. And we've just seen things take off from 0 to over 20, meaning that short-term interest rates, 2-year interest rates are now above 2% for the first time in over a decade. And just over the last year or so, we've seen intraday moves of the 2-year interest rates. 9 times they've moved more than 125 ticks, which is a very large amount for some of these short-term interest rates. And today we're basically sitting at highs we haven't seen, over a decade. So huge price action in interest rates today at 3 standard deviation alone. So.
And to be clear, you're speaking towards the movement down to 0 since the pandemic, because we did, between the start of the pandemic in 2020 there, we did have a move higher in short-term rates between the 08-09 crash and that pandemic. But it's a similar process, right? Where something happens, the Fed takes interest rates down to 0, like they did in this most recent example after pandemic news started to spread. But then the countermeasures of that finally come in, where it's like, all right, the pandemic is less of a fear than it was. And now, since you took these actions, FOMC, to spur on economic growth, now they're kind of getting a little fast and loose on the other end, where inflation's spiraling a little bit. And so instead of interest rates crashing down to 0 like they do when something like the 08 crash or the 2020 pandemic kicks in, now it's the reverse of that, of like, people are worried about inflation and rates are skyrocketing, and these markets are moving higher than the Fed can actually hike. But story aside, I want to speak a little towards how you would defend against a position like this, that you and I got in a little early. When you see an outlier like we've seen here, a market, moving hundreds of percentage points higher, like the S2Y futures, the small 2-year yield going from 0% rates to above 2% rates in a matter of a couple months, you are likely to get there a little early if you are a contrarian going against an outlier. And this is, one of those less than 1% of the time outliers we've seen. So you can't blame someone like you or myself to be like, oh, this happens less than 1% of the time, I'm going to go against it. And sometimes those outliers continue against you. And that's why we have, thankfully, some trade defense. This is something that you did yourself. Maybe speak a little bit towards, if I'm short 2 years, and then there's a similar product like the 10-year yield that's not that's not moving as high as that 2-year, I can buy that similar product against it, and it's evened out your P&L, right?
Yeah, absolutely. This is an amazing concept that I picked up just over the last few years. And it's just spread trading in general to reduce some of your core position risk. So the same way that when you're trading options, you can sell an option and buy something against it to kind of reduce that buying power effect, reduce that risk. You can do the same thing in outright futures by finding highly correlated products. Now, the good thing about interest rates is that across the whole yield curve between twos, fives, tens, 30s, et cetera, they all tend to kind of move together, really strong correlations between all those different durations. And the neat thing you can do here, if you're short 2-year interest rates, is you can add a bit of long exposure to either 10 years or 30 years, with the hope being that if 2 years continue to rise, you'll also see an increase in 10s and 30s. The whole yield curve will kind of shift higher. So the losses that you experience in that front 2-year short position will be offset by equal, if not greater, gains in another long position in 10 years or in 30 years. So that's exactly what I did, is I isolated my exposure to be the difference between twos and tens. So now this upfront move in 2 years to highs we haven't seen in quite a while are actually being offset by gains in a 10-year position as well. So I'm only trading now the difference between the two rates. So I'm not subject to just one leg really whipping around and fluctuating my P&L.
Yeah, the idea is I'm short the big outperformer, and I'm going to buy something that's very similar to it, just a different yield product that's not performing as absurdly to the upside there. And if they continue, hopefully I make up some ground on that other piece, take outperforming a little bit when it's been underperforming. And if they do reverse, which is probably what I'm still looking for, that 2-year hopefully crashes more than that 10-year that I bought against it. And you can always underhedge. You can do 2-to-1 or something like that if you want the extra exposure. Also, Mike, you can go to a similar product like TBT, which is a short bond, but for all intents and purposes, kind of like a long yield product. And I could be short 2-year yield futures and sell a put in that TBT 1-for-1. They're very similar size products, and offset some of my risk there. I'm short maybe the S2I around 20, and I sell, the 20 or 21 puts in TBT for 50 cents or a full dollar, offsetting some risk there as well, getting some trade defense. And last thing, you can also use some macro trends like we've talked about recently. This is probably your least straightforward trade defense, but you can go to something like this and say, all right, interest rates, I'm short and they're ripping through these all-time highs. And you look at gold and silver and it's like, man, these markets that are almost direct inverses, non-interest bearing assets, are still near their all-time highs. I could go there and get a short on in metals and use a macro trend to hedge with that short piece there. And so if S2Y, if yields continue higher or stick around here, at some point, I'm thinking metals will cough up their recent gains, given that they do have an inverse relationship. But Mikey, that's all we have for today.